Good morning and welcome to the World First Weekly Report for today, Friday the 5th of August. Well, over the last night we've seen the equity markets tank. We've had the S&P 500 off 4.8% and as a result the Aussie has free fallen. Over the last 24 hours the Aussie has come off 3.5 cents. It's gone from the high 107s down into the low 104s, and this is really off the back of some risk being attached to the United States. Earlier in the week we had some good information out of the States. We had the debt ceiling increased. That legislation was written into law by President Obama literally 10 hours before it was due, and that was widely anticipated to be a positive for the markets. However, the markets were fixated on the long-term growth prospects of the US, and as a result the S&P 500 came off 2.5%. On that day the markets were fixated on the personal consumption expenditure figure, not a key figure but important all the same, and they fixated on that figure with PCE coming out at negative 0.2%, and as a result we saw the Aussie get sold off. Furthermore, the news out of the States has been pretty grim. With the debt ceiling being increased, the prospect for further fiscal stimulus is actually quite limited. This is increasing the bets on quantitative easing to be continued, or the extraordinary asset prices to be continued, the so-called quantitative easing, or QE3. That's really been the only saving grace for global markets, and you're in a bit of a tight position if that's the key reason why we're propping up equity markets. So in other words, the writing was on the wall going into last night. Overnight we had the big sell-off in the equity markets, and what we're looking for is either QE3 to come about in the short term or for the guts of the US economy to turn in the short term as well. On that front, look out for the non-farm payrolls figure coming out tonight. The expected figure is 91,000, and if we get more jobs added during July than that, then that'll be a positive for risk appetite and a positive for the Aussie. Locally, there's been a lot of economic data out of Australia over the last week. On Tuesday, the RBA kept interest rates on hold at 4.75%. This is really off the back of the high inflation. We're currently travelling at around 3.6%. And there has been some weak data, but with the target range for the RBA of somewhere between 2 and 3%, they didn't have the opportunity to drop rates despite the weak data this week. The economic data out this week largely fell within estimates. We had private sector credit, performance of manufacturing, new home sales and retail sales, and we also had the trade surplus. Obviously that's heavily impacted by the mining sector. The trade surplus actually contracted 25%, and that's obviously not a positive for the Aussie dollar, and so we're not going to see many key drivers coming out of the local economy to keep the Aussie pushing above these current levels. In China, furthermore, we had their manufacturing data out. That was a lackluster figure. We're not seeing a lot of growth in the manufacturing sector. That figure came out at 50.7, with anything above 50 being expansion, but obviously, as you can see there, their manufacturing sector is taking a bit of a hit. This just means that the likelihood of the Aussie having some weight behind it to go higher is pretty limited at the moment, so you might want to secure some levels, you might want to secure some currency at these levels just to hedge against the risk of the Aussie going lower. In the Eurozone we had some Spanish bond auctions this week. The bond auctions were widely received as being quite positive. For example, on the 2015 bonds, the $1.1 billion raised, their yields that were achieved came in at 4.9%. Now the trigger for the recent collapses in the Eurozone was a yield of 7% on 10-year debt. With the release this week we saw the 10-year bond yield come off in Spain. That dropped to 6.26%. So it's still pretty close to the 7%, but that gives the Eurozone and indeed the Spanish economy some room to implement their austerity measures, and is widely considered to be a positive for risk appetite. Because of the good news from the Spanish debt auction, the Aussie euro came off, and we're looking for further losses on the Aussie Euro just off the back of the heightened risk via the US. Look out for that economic data coming out tonight. In non-farm payrolls, we're looking for a figure of 91,000 or more. If you would like an update on the market, or if you'd like to book a trade, don't hesitate to get in touch. Enjoy your day.